Trading the agent sweep was hard until I discovered this. This will be a full course going over how many mistakes, common mistakes with agent sweep, agent rage types, high-end in probability, scalping the agent session using one specific level every single day, finding daily buys. All of this can be found utilizing the small piece of price action, which is the agent range. When it comes to someone trading style, I cannot trade without having the agent session range on my chart. What is the agent session range? It's the price action that develops within the agent session time window. And any time that I mention on this video or any other video on my channel, always EST, New York time zone. The agent session timing is from 20, which is 8 p.m. until midnight, with all EST time. And usually, this agent session usually is a consolidation or a range, which means, man, it's a low volume. The importance of the agent session range, engineering liquidity. In other words, engineering liquidity means that after that, there's going to be a manipulation. So liquidity leads to manipulation. Without liquidity, there's going to be no manipulation. Now, the importance of this is that, and that's why I use the agent session every day, and without it, I cannot trade. I cannot have a framework for my day. So the importance is agent session is that it's a reference to trade London or New York or both. So if you trade both, you're going to have the agent session range as the reference to actually advantage trading London and New York sessions. Your framework, and the importance of it, again, in engineering liquidity is accumulation, is a range, and agent session is usually a low volume and usually consolidation, so it's accumulation, which leads to manipulation. So it's a good time to trade. It's a good level or a good range to highlight every day in order to capture the manipulation, and after that the distribution. Now, agent range, regardless of the naming, right, because it's a range, but it could be a trending. So regardless of the name, it could be a ranging or trending. So now ranging, it could go from 10 to 20 pips, trending to 20 to 30 pips, more or less. But this is not the most important of it. The most important aspect of it is how you look at it visually. How did this look visually? So let's now you have something like this. What is this? This is a structure. That's a trend. The supplies going to the lower side, creating lower highs and lower lows. So that's a downtrend. So that's not ranging, that's trending. So when I see something like this, highs, lows, I see breakout structures, and I see, you know, either low resistance and higher resistance repeatedly runs, I know that this is not ranging, this is a trending market. So visually, you can see if it's trending or ranging. Now, a range would be equal highs and equal lows, or most relative equal highs and relatively equal lows. Or mostly try to focus on the ranging one. It's going to be easier for you to trade, and it's going to be easier for you to spot the manipulation when it's trending. It's going to be harder and more tricky to capture that manipulation or that swing move. Now, the main goal of this video is that I want to show you this common mistake that a lot of people do, and every day, even my students, I see a lot of them seeing this mistake. What is this mistake? It's when a lot of people looking for the agent session has a reverse. So agent range, high and low, and looking for a sweep on one side and a reversal to the other side. So for example, sweeping the low and taking the high, or sweeping the high and taking the low. Now, the thing that it's not going to be all the time sweeping the low and taking the high. Now, forget about the high, but it's not all the time sweeping the low. It could be breaking out below that low. And how do we know that? This is what I'm going to show on this video. It's going to go over the times, the frameworks, and different types that you can see in different days. So you're not only counting on this, counting the low or taking the high, but then spotting the reversal, but it could be continuation. We're going to be focusing on agent range types. So understanding agent range type, put on the right framework. Each day we have different types of agent range, which leads to a different type of framework. And understanding the different types is going to help us not only to get trapped into the wrong scenario. when we have a continuation, or we're not looking for the reversal or the opposite. So we're going to go over the types one by one and show you the pros and cons of each one and how to build a whole framework around that time. So the first type is going to be an expansion near a point of interest, POI. So what does that mean? So the first thing is the expansion, so it's not ranging. So we have expansion, which means that this is not the highest probability one, but still, if you know how to build a whole framework around this and how to use it the right way, it's going to be very, very easy to execute. So just that the expansion or the trending, not the highest probability. But when you understand this specific type near a point of interest, an expansion towards that POI, then it's going to use it in a good framework. So you can have a trending Asian range approaching a POI. So the trending was on the same side or towards that POI. The low or the high is going to be swept into the POI, and then on the low and then open. So you have the Asian session from 8 to midnight. And then the low of the Asian session is swept inside of the POI, or fair value gap, or the block, or liquidity sweep, you name it. We have the sweep there, and we start going lower. And then we got a breakup structure here, and this is breakup structure confirms that, okay, we're going to go up. And we have this low, most likely the low of the day, and we're going to go up. And we could follow the order flow from here or from there. From here, or follow the gap here, price couldn't go lower and go up. That's the direction. And you see an example, this is the new chart. So we got an Asian here, London and New York. This is a delayed manipulation, but it's the same. So we got a 4-hour order block here, which is our high time frame POI. And we have Asian range, which we can see that it's going to what side? To the upside, where we have the 4-hour order block. So it's approaching that order block. That's the first thing we see. Now we're going up. What do you see that on its Asian range is trending? It's literally going from the bottom to the top of the Asian. So it's very bullish. What happened on the London is that a little bit of accumulation or a range. So we didn't have a real move or the real manipulation yet. And why does this happen? You're going to know in the next slides, right? But you're going to know when it's going to be manipulation in London or when it's going to go accumulation in London. What happened after this price sweeping the Asian high inside of the 4-hour order block in the same direction of the trending? So you see it's trending here on Asia to upside, and manipulation is going to up to this upside. We sweep the actual 4-hour order block and we start to come lower, and we see market structure shift as well as an inverse fair value gap, and confirms that actually we are to go down. What's happening is the price keeps going lower, order block going lower. Again, liquidity pairs going lower and going more lower, even on the next day. So this is the Judas swing, and even if it's a trending Asia, we can still count on this as and trade on it. But there is a higher probability, which is going to cover on the next slide. So the second type is the expansion into and out of a POI. And what does that mean? That means that we have a POI, fair value gap, order block, whatever sister says. And 20 to midnight, we have an Asian range, and it's not a range like accumulation, equalizer, equal lows, but it's like a trending on one side and trending on another side, so we're a V-shaped. So this placement on one side and this placement on another side, and where was the reversaling happening? And this is actually the smart money reversal, or the SMR. When we have a smart money reversal, what will tell us that we're starting a reversal, and that high or that low is going to be protected. In this case, it's going to be that low here. So it's going to be an expansion to a POI of out of a POI. See, expansion in and out. Then the high or the low is usually protected. It's going to determine that the direction. You see, creating this low here into a POI and then displacement above. It's telling me that we're bullish for now. And the significance of this is that when we have with this type of Asian range, the price will respect the Asian range PD arrays. It's a good thing, you see. So it's respecting PD arrays, mainly this one. This is the Asian range. So why does this happen? Because what happens is that price was actually trending lower in order to reach that point of interest. So now we wait until the London open to go to the SPY. we actually fill this PY inside of the agent range, and then, or the agent session, and then we start going higher, displacement in, displacement out inside of the agent range, and then we have a break of structure, and any PD array in here is going to be respected. A lot of mistakes of what people are going to do, which is really a silly mistake if you don't understand those, if you don't understand these frameworks, or is they're going to look for this low to be taken or the height to be taken. What's going to happen is that the low is not going to be taken. They're going to miss a lot of trades not taking this PD array. And the other thing is this higher right here, they're going to look for short, when in reality, the higher time frame is showing it that it's bullish, and its significance in the price action is telling us that from here, this right here, this low is telling us from here onwards, we're going to starting to go bullish, which correlates with the existing higher time frame, respecting time frames and order flow going higher. This is nothing more. This downside, the short one, to mitigate like a pullback and to go higher. It is not price to go taking the agent high is going to reverse to the low. No, the low is protected. The high is going to it's going to be a small retracement to a pullback, and it's going to reach a new high. So do not make this mistake. Avoid this mistake. Understand this, so you can differentiate what is a model 22, a unicorn model, and a reversal model within the Asian session. Very clear essential on that is the 30-minute Eurodollar. We can see that price action actually before the start of the Asian range was happening is that there was a lot of expansion toward the PY on a higher time frame, as well as a previous week high. So we're going above, and we see the start of the Asian range. What happened here? We did not create a range, and then we waited for the high to be taken and going lower. But no, what happened here is that the smart money reversal is actually happening inside of the Asian session. You see, we're going up, we're going up, we're going up, and we inverse fair value gap, and we're disrespect the fair value gap, creating a new fair value gap, respecting that fair value gap. And you see this box from here to here, and this level right here, you're going to know that why this level is actually significant in the next slide. You probably already know, and you can actually scalp based on a unicorn model, model 22, and make money. Okay, so that's a gem you're going to learn about. So we start to go lower, going to mark a structure shift, and we got inverse fair value gap, and we got fair value gap on the other direction, and we started going lower. I think about it this way. A lot of people are doing it here. They're looking at this high and low, and they see that, oh, okay, the low is taken, then going longs here, right? Because its price is going longer. It's not. It's a reversal. It's an in and out on the POI in the Asian session. So they keep on going for longs when in reality the direction is very clear to the downside. And why? Because we have expansion into a POI and out of a POI, right? So, and we got a pretty much restriction, market restriction. That's it. That's it. We're going lower. We're going to look for longs and so forth. Correlate this with the higher time frame bias. Very important. And sometimes with price will reverse, and you know that there's no entry, and it's okay. If I was actually, I'm not trading this. If I was be losing from up to the top to the bottom, I would stop for the day. But this is a mistake people do. We're going to be understanding of the order flow, and the second type tells you where the order flow is. Now the agent AR type 3, which is the most profitable and the easiest one to trade, which is the type 3 raging and sweeping to a POI. So we want to see Asia range as in a range. This is how it should be. Asian should be consolidation, should be a range. And you're going to know why, and you're going to know the quarterly theory with the relationship between the range and the Asian range being a range or being trending in relation with the manipulation. Okay, so this is what we're going to be learning later on the next slides. For this type, what I want to see is Asian range, relatively equal highs, consolidation. I want to see a high time frame POI above or below the Asian range. So you can see that we have a POI below the Asian range. And I want to see, when I see that, I know that a POI means that direction, and I know that the sweep is maybe going to be to the lower side. POI to the lower side, which tells me the direction it's to the upside. So it can determine the direction, and this is the best Asian rape time for me, of course. And you don't know why. So you're going to be looking for ranging, Asian range. and we're going to looking for the sweep after the London Open, 1:30 until 3 a.m. and market structure shift afterwards, CSD, change in stage delivery, and that determines the direction, fair value gap, order flow, and going up. So this is the best one, and we're going to go with some examples now. But before that, I want to show you something very important about this and why is this the best type. If you have a little understanding of the quarterly theory, you know that we have two scenarios. A lot of people actually only focus on one scenario, the AMD, accumulation, manipulation, and distribution. X continuation for continuation or reversal. Other way will be trending. Displacement, because it could be something like this, continuation to the upside, so that's trending, or it could be what? Reversal, and that's also a trend here by itself. Now AMDX, accumulation, manipulation, distribution, and X, as I said, reversal of continuation. Now why is this type 3 the best? But when it comes to ancient range and quarterly theory, we're going to learn that in order to have a manipulation on London, what I want to see in Asia is an Asian ranging session. Now I have another scenario when the first session of the day, or the first quarter of the day, which is usually the Asian session, if it's not accumulation, then we might have a delayed manipulation. So manipulation is going to be on the third quarter of the day in this case. So if I don't see accumulation in the first quarter of the day, which is the Asian, if it's not ranging, then there is not going to be a manipulation. There is not going to be manipulation. That's why we need to see an accumulation in the Asian session. And this is really important on the first quarter of the day or on the Asian session. When applying this and following this specific scenario, it's going to lead us to this timing of the manipulation time. The manipulation time is going to be from 1:30 to 3 a.m. New York time, always. This is the manipulation quarter of the day. On the London session, usually it's going to be a session like this, like going lower. This is high of the day. Yeah. So example of this, we got Euro USD, 15 minutes, and if I do trade every day on this. So everyone we trade this, and people are actually being proficient with this strategy. So for our fair value gap, this is what we have coming into the fair value gap. We got an ancient range, which is consolidation. So low, high, low, high, low, high. And it's a little bit not a real consolidation here. So not really straight consolidation, equal highs and equal lows, but it's still a range. It's not exactly doing exponential range style. So we got this one. What happened at the start of the London kill zone? So this is 2:30 a.m. So 1:30. What happened here is that we sweep the Asian low. We push higher and we created an inverse fair value gap on the other direction, respecting the side going up. So when I see this signature in price, I know that this is the low of the day, and it's I'm taking this directly. So this is the bias that I'm going to go with, and I'm going to correlate with actually higher time frame. So this is going to be a bullish bias. Look for the continuation on the next hours, and including New York. For the whole day, this is the real reversal happening here inside of this 4-hour fair value gap. Asian range, sweep on London, determine the direction, and we start going up. Another example is we got a 1-hour fair value gap here, as well as a liquidity level here, and now we see we also have the previous London high. Well, not previous, but an old London high that is not taken. We started going up here, and we see we have low, and we'll still consider this a PY. We got 1 hour because it's not that big expansion. This is 15-minute, remember. So 1 hour fair value gap here. Price was coming close to that, created a range here. And so this is a range, and we took that 1 hour fair value gap, we respected it, and we started going lower, creating an inverse fair value gap. This is the first time of the reversal. We started going lower, respected this fair value gap, and another respect on the fair value gap, and low, respecting the fair value gap. So this high here was the high of the day again, using the same framework, and it determined the direction after, and based on this, we can actually could have taken 2 to 3 trades a day, which I shouldn't advise, should allow you to actually trade 1 time a day, it's enough. The same damn happened here, so it happened here too. We're going to focus on this one. So we don't have a ranging. We started range here, so we can still consider this as a range. I mean, it was not ranging here, like it's ranging here, and the end of the actual Asian session. So what happened here is we set the Asian session, the low, at the start of the London hour, almost at 3 a.m. into a 4-hour order block, and also a daily fair value gap. We started going up, market structure shift. We came lower on New York Hill Zone, and we came like exactly the OTE, optimal trade entry, the 0619, and we going higher. It's another bias of the day. So we could take this CISD here, OTE, and another trade somewhere in here, and we started going higher again. See? So it's pretty easy. I don't take 5 to 1, 6 to 1, 10 to 1. I'm more into 1 to 3, 1 to 2, 1 to 3. 1 to 3 is the best, what I'm currently scoping based on the existing win rate. And you're going to know why in the next thing. It's scalping opportunity every day. So Asian Ray, 50%. This is a gem that you really want to take advantage of. So when we got Asian range from 20 to midnight, we're going to be marking the high and the low, and either it's a range or a trending. So any type of Asian range, you can still trade with it, right? So we're going to mark the high and the low, and we're going to grab a fib from the low to the high, or again box, and mark the 50% of the trend. We're going to notice that price tends to respect this level. You see, we start going below the trend 50%, and we're going to lower, and we maintain the existing middle of the actual. Even if we're bullish, we're still going to see a reaction at the actual mid of the actual range, and then we're going to see it retesting the level and going higher. Now we're going to go over some charts and see how you can actually take advantage of this and see how this level is really significant. The importance of the 50% level, let's say we're going to be looking at this price action here. You see we're Asian range here. Pick up the GAN box here. Looks like this, and 0 and 150%, and we just go track it for the low and to the top, to the high of the Asian range, maybe extend it a bit. And we're going to see what we can obtain here. So this day was NFP day, not really the best day, but like, for example, let's get another one. Any type of Asian range, we're going to drag it from the bottom to the top. And you see what happened here is that price breaking below, coming above, rejecting from the middle of the range, second opportunity, rejecting, going lower. And if I drag it more to the right, see, again, we reach one time, go lower, another time, another time, another time. And if we push it a bit more on the next day, price is still respecting this level, which is very interesting. Same thing happened on this day. So get my GAN box from the high to the low. And what do we see happening here? Let's go extend it a bit to the right. And what do you see? We immediately, after the end of the Asian session, we see 50% going lower. And after that, we're just below the Asian range. The other day here, we're going to take the GAN box again from the high to the low, and which is right here. And we're going to see happening. Immediately after the end of the Asian session, after midnight, we had price coming back to this range, 50% Asian range, respecting it and going lower. So that's a huge opportunity. As you can see, that's almost, I don't know, it's a massive trend that you can actually capture and take advantage of. This one is even better when we have what? Another PD array. So we got this order block right here at the same level. Right now we started going lower. So, and it happens all the time. So you can double correlation what you currently have and add an increased level of correlation, so you can actually increase the proficiency level for your trade. So in this case, will be an A++++, something like that. So this almost happen all the time. You see this range here. This, let's stretch it a bit. Like, there we go. This one is a bit tricky, but you see, go above, go a little below, and a below of retracement, going up, and we're going to come back to it. This level, you see, we have another day here. This one, Asian range, we go above, we go below, and then we have a reaction there, as well as this one there, and there's nothing much. But it's interesting how it relates. So we have a trending one here, for example. We extended a bit, almost very close to the 50% into this order block right here, and we started going higher. And then we go below, we go above, and we're just hanging around those levels until we actually get a real breakout where we go and going in one direction. But as you can see, it's a very, when it is a big trending day or when it is a big range, it's really interesting. We want to see a big range like this instead of a small range like this. This is more significant, and when you take trace of the 50%, can actually get some good reward to risk for that. And like a small range, where it's going to be a V tiny and really tight, and you cannot get a lot of reward to risk. So when it comes to the identifying the bias, the engine range will help you determine the bias every day, every single day. So let's just looking at the engine range and highlighting the price inside of it and what happens afterwards, especially after the London kill zone. If we have Asian low sweep and a market structure shift displacement up to the upside, so you see you got something like this, low taken and displacing above, then you especially if there's a fair value gap there, it's going to tell you that the bias is bullish. On the other hand, if you have an Asia high sweep, market structure shift, and a displacement to the lower side, it's going to tell me that the market bias is bearish. So then this bias is, when you're looking at it, it looks like price action leave that happen after. And looking at this, you can have gotten a trade on London, and after you gotten another trade on New York, already a trade to 1 to 2 trades a day maximally. So you can have 2 high probabilities, one in London and one in New York, and this is the maximum that I would advise with proper risk management structure. Another thing is low resistance liquidity and high resistance liquidity and the relationship between them and bias. And so imagine knowing the bias. No, it's not going to be as high probability as the market structure shift and the inverse fair value gap and the other methods that we use. But imagine knowing the bias just by looking at the chart, just looking at the price action instead of the engine range. So how do you do that? So simply you're going to be looking at where we have a low resistant liquidity and highly resistant liquidity. What does highly resistant liquidity mean? It means that we have breakout structure and we liquidity already taken. So in the side of the curve, we have liquidity taken. On the other side, we got low resistance liquidity, which means that we have this high, we have some liquidity here, when we have enough more liquidity here, and more. See, liquidity not taken. So when I see this, I can actually establish a bias just by understanding the order flow. So call it LRR. So at the start of the London session opening, I know that the price is actually going to go on the side of the low resistance liquidity. So if I see a sweep here, in the side of the higher resistance liquidity, is telling me that the price is going to about to reverse, to go to the other side to take the actual liquidity pool created on the low liquidity resistance liquidity. So this is how you find bias, just a bit of market structure with price and bias, so you can understand. So this is not a long-term bias unless you look at a higher time frame to actually understand it. So make sure to use this and let me know how you find it. So in this day, for example, let's go for an example. High resistance liquidity, this price was taken. You see we have high resistance liquidity, another liquidity taken, another liquidity taken. And on the other side, we have higher not taken, and not taken. So you see, it makes sense to you that price is actually going to go to the side where the liquidity is, where there's some liquidity to be taken, which is this side right there. And what happened is that after the London open, we took liquidity. This liquidity is taken, fair value gap respected, and price is going to the direction of the low resistance liquidity just by looking at the Asian session by itself. That's also another example. You see breaks of structure, and until we get to where the inverse fair value gap, and you got a microstructure shift where this price go to the low resistance liquidity. And we started going higher from there. So if you want to become profitable using the Asian sweep strategy and utilizing the Asian session and the London Open, then this is the way. This is the whole framework you will need with the timing, with the conditions, with everything in details. Really want to become successful, you need to use this. I explain everything about the Asian sweep in this video, which is actually the initial one that we created before, and it's almost, I don't know, several months, and a lot of people are actually using it every day, and they're telling me that this is something that we settle with, this is something that we are looking for every day. And since then, actually, March 2022, this is what I've been used since then.